One of the biggest reasons why people in crypto end up losing money or they end up with average or even below average returns is because they struggle to build a well structured portfolio. Once I joined crypto, I made many of these mistakes by myself as well. And if this is your first or second cycle, you will probably hear some views that you haven't thought of before. So stay tuned. Hello everyone, I'm Željko and welcome to Crypto Grid. So firstly, above 80% of you who are watching this video are not subscribed. So if you like this video and the content that I'm creating, I would highly appreciate if you would subscribe. It's one click for you and it shows me that you appreciate the content that I'm creating. I saw a post on Twitter from Metiverse who have above 200k subscribers, and this is what inspired me to create this video. So if you look what he did is he invested into 40 different coins across different niches, $500 into each of them, and you can see that the best performing one is Agix with 85% returns, and the worst one is Avax with minus 8% returns. If you would sum up all these numbers and calculate what's the average return of the whole portfolio, you will get around 8.1% or something like that, maybe slightly above or slightly below it, but that's it. And if you look into the portfolio that he has, you can see that there is like a part of portfolio that is outperforming that and the part of portfolio that is underperforming it. What is the conclusion of this? When you're investing into the more assets and you're diversifying your portfolio more, you are reducing the risk. If some of the assets fall 100%, you would lose only $500, but you're also highly limiting the upside. And this approach might be good for somebody that have like 7-figure portfolio or more, but for somebody that is at like 4, 5, even 6 figures, I wouldn't use this. Yeah, you can often hear from people that are investing into the regular markets that you should have like 60-40 portfolio where you have 60% in bonds, 40% in stocks, and maybe at the moments when you have a sharp pullback in stock market that you should switch to have 60% in stocks. But in this case, you always have one asset class that is going up and you have another asset class that is going down. And that's okay and that's normal to happen. But my issue with investing in 40 different coins is that like once you start investing in more than few per niche, you're just investing into the coins with lower conviction rates. Also, funny thing is that a lot of people are looking for videos what are the best coins to invest, where you should put your money in, and they're pretty much thinking in a way that if they invest into more different assets, as they're investing more money. Sometimes I feel that people don't realize if they invest $10,000 into 10 different assets, it's still the same amount of money invested as if they invested $10,000 into 50 different assets. And you should not look into the markets in this way for the multiple reasons. In my opinion, like firstly, you should always invest in the niches that you're familiar with, and you should invest in maybe 2 or 3 different coins per niche. If you invest into the 10 different ones, most of them will have high correlation, but you will often see that 1 or 2 are heavily outperforming pretty much all the other coins in that sector. When we are looking at the niches you should invest into, if you never played Web 2 games, you should definitely not invest into the Web 3 games, because for you it will be much harder to resonate with the people that are actually playing these games, and it will be much harder to predict the future and how this can develop and what the final outcome will be. Same applies for DeFi, for example. If you never staked any assets, and especially if your portfolio is small, like 10% APR usually won't make a big difference in your portfolio. While if you look for someone that have 1 million stake and he's cashing out his money each month, sometimes this will hinder the performance of that coin. And if you look at the high APR projects, usually the people that start exiting first make the largest gains, while everyone else is making smaller gains or even lose money. Another thing is that if you're holding 50 coins or something like that, is it will often happen to you that you even forget what you're holding. It will be difficult to track what you have, and it will be difficult to time the performance of each coin since usually different narratives perform differently during the market cycle. And even if you hit the good narratives and hit the good coins, sometimes it will happen that you still take average return just because you're holding many different things, and it's difficult to track and to know when you should actually exit the projects. And especially for smaller cap ones, the time frame when you can exit is usually pretty small, just a few days. While if you're investing in BTC, for example, you have a much larger time frame when you can exit and still take high returns that are not much lower than if you sold at the top, for example. Here it's really important that you're honest with yourself and how much time and energy are you willing to devote into it. And also you need to be aware of the fact that nobody can tell you that we're gonna have a peak of market cycle 15 months after the halving. It's usually when we had it, but you never know what will happen and how much you will need to wait as well. So you need to be aware of the possibility that you might need to invest more time into the markets. 15 months from now, you might need to invest that time 5 months from now. It's something to be aware of. You also need to think if you're investing a certain amount of money each month or if you have just initial investment which you're managing over time. Also, if you look into the charts, you need to realize that there's some time in the markets when you're looking to make money, and usually that's in the bull market, and there's some times in the markets when you should just look to preserve it. Yeah, you can short the markets, you can do different things, but using spot markets, buying the assets, you always have much higher upside than you have limited downside because you can only lose 100%, but you can gain 500% on your position if you're not using leverage. So this is something that you should have in mind, and you should be aware that things can change up quickly. And usually when we are actually switching from bear market to bull market, many of the people are in disbelief and they're always expecting the price to create some higher low. Instead, we are usually getting higher highs once we get like 80% drawdown or something like that. And if you compare the price of BTC with the market cap, usually they follow each other with a small delay when it comes to the market cap because Ethereum and other altcoins might start outperforming best at the later stages of bull market. Another reason why tracking everything that you have is important is because eventually all the altcoins either go to zero, either they have huge drawdown. It's not for all of them, but it's for like 99% of them. So if you keep holding something and hope that it will again go up, you might not be right, and you might just see how you're seeing a larger and larger drawdown on that position. This is the reason why I try not to hold many positions. I usually hold 3 to 10 different positions, and I'm usually trying to follow the narrative which is already trending, and it's much easier to jump on a boat that is already going up than to spot something that will go up in the future. When it comes to large caps versus small caps, it's personal preference and your tolerance to risk. Usually I like to combine both of them, where for the larger market cap coins I am looking to take profits starting at like 10-20%, while at the smaller ones usually you want to wait them to go at least 2-3x. For some of them people are waiting to go 100x. But honestly, I always prefer taking profits on the way up. For example, if the project goes 2x, you can take 50% of your position. So pretty much you are de-risking yourself, taking the initial position. Once the project goes again 2x up, you take another 25%. Once the project goes again 2x up, you can take another 12.5%. So pretty much you're cashing out your initial investments each time as the project goes 2x up. The same applies when you're entering the project. You should never invest like 100% of your position and the amount of money that you're willing to devote to that project all at once. Usually I like to invest like 1/3 or 1/4 of that money and then if the price decreases, I just invest more. If the price goes up, I start taking profits, as I initially said. Yeah, sometimes this will lead to the situation that you don't have the big position as you wanted in the certain project. But let's say if you invest into something and the price of the project goes 50% down, pretty much you are limiting your drawdown to 25% in that case if you are doing the second investment into that project at that 50% drawdown. When it comes to the rebalancing your portfolio, it's something that you should be really careful of, and it's something that I'm doing only when I feel that one of the narratives that I was riding is exhausted. This is the moment when I switch it, but you should really be careful, and compare if your initial investments into the certain projects would actually outperform your rebalance portfolio, and you need to be careful of the fact that you're actually taking the money from your winners to invest into the losers or to invest into something new. Remember, majority of the winners will remain winners, majority of the losers will remain losers, and this is how it goes in the markets. I often hear from people that they invested into something during the previous market cycle, for example DOT, and they still hold that DOT instead of maybe selling it, taking that money out and investing into something that is actually moving. Sometimes it's even better to accept the lose and to move forward than to just stick to your position and seeing how you're experiencing bigger and bigger losses. Or even if it's not a lose, it's just a frozen money at one place that will almost never reach the initial price at which you invested. So when you're structuring your portfolio, remember that you need to manage every position. So try to limit the number of the positions that you're holding. Remember that you need to pay taxes when you're exiting these positions. The more positions that you're holding, you need to do more research, you need to devote more time to see what is happening with these projects that you invested into. So my advice is to look into 3 to 10 positions which you research highly, where you have high conviction rate, and this is how you will outperform majority of the other market participants. So I hope that you liked the video. If you have any questions, write them in the comment section below. Thank you for watching. Stay strong and healthy. Bye.